Yeah, let's go live.
All right.
All right. Good evening, everyone. Thank you so much for joining us. Share this page. We got a special guest, special topic on this evening. You want to share this, you want to like this, you want to make sure you mark it down. We received most of the books on yesterday. Few of them, I think, still are on their way, but don't worry, be happy. We're going to get that book to you. And then if we go over the 100, we'll just tap into Mark. He has a special thing he does with them that he didn't let me know about them. We'll do that. We'll do that and make sure everybody that's listening, you need a copy of this book. Everybody that's listening, both books, you need to grab, close, take notes, listen to this interview. I am excited for this guest as any other guest before as it relates to the topic of money. And he is consented to share with us today. We just reached out to him on Facebook. I'm giving you enough time to come in the room, to share the page, to like the page. As you're doing so, I want Mark to take a moment and tell us about his journey into his expertise now of money, what led him through that way, and then we'll get into the conversation of the book. And then let me say to you one more time, brother, thank you so much for joining us.
Well, thank you, Pastor Her, for having me on. Anytime I get a message like the one you sent me saying that you read the book and you reached out to me on Facebook and said, I love the book, I want to get a bunch of copies in the hand, 200 copies into people's hands. That's exciting. That's exciting for me. I didn't write a book, so it sits on the shelf, and I'm just grateful that you read it and you saw value in it, and you can see how the book can help people, because I spent a lot of time on those books. I'm very proud of those books, and we just passed 100 ratings on Amazon right now for top 10 ways to avoid taxes. So that's a huge accomplishment, and the book's selling, and we're constantly getting great reviews back from all across the country. And I'm just excited to be here with you today, virtually on your Money Matters Monday. So
Thanks so much. Tell us about your journey into the field. What made you start studying money?
Basically grew up with no money, and that's a good motivator to make more money, is when you have none. And I was born in Canada, and my dad was a miner. He used to mine nickel in northern Canada, where it was like 50 below zero in the winter. So I grew up around my dad would, he'd need to make dinner, so he'd go snare a rabbit or shoot some duck and bring it home and make dinner. So grew up around very hard mining town, or at least I was born in a hard mining town in Northern California or Northern Canada. And then ended up living in Ontario, Canada, and we never had any money. And just growing up with no money, there was no financial literacy in the house. There was no access to financial education because there was no internet and things like that. So there's just no access to financial literacy, and it's just it was very frustrating to me to grow up with not knowing how money works, having no money. And then I finally went to college in Canada, and I went to college and I went to business because I wanted to learn how money works. And what I learned, and then I ended up with huge student loans and huge credit card debts. And I was like, wow, I went to college for business and I ended up with a huge amount of credit card debts and a huge amount of student loans. And I just didn't learn what I was wanting to learn. I didn't learn how money worked. And it was just even more frustrating attending college for business. So 15 years ago, I left Canada. I moved to California. The whole American dream thing, I believe in that. I think American dream is still alive and well, and I came here for it. And I wanted to learn how money works. And I read a book called Rich Dad, Poor Dad. It was the first book I ever read on finance, and I think most entrepreneurs have read that book. And I learned what you should be doing and what you shouldn't be doing in order to basically increase your financial literacy. And that's when I dedicated to become financially literate. And I've pretty much spent 20 years trying to increase my financial literacy and learn how money works. So it's been a long journey, but along the way, figured out I could actually write a book, which is kind of cool, and then figured out I could write another book. So that was even cooler. So today it's fun to be. I don't have to have a job today. I can just sit here and chat with you, and we can talk about finances and enjoy our Monday.
We'll usually do this at the end, but I want to do this now and do this also at the end. Tell us where people can find you. Tell us the 2 books that you've written. if people want to get in contact with you for advice and pay for your services, let us know about that right off the bat.
Yeah, sure. So the first book is Rich Man, Poor Bank, and that is basically it's a book about the banking industry. And the big thing that I realized when I was in college, student loans, credit card debts, is there's a lot of money made in getting you into debt. And there's a basic thing that says save money and get good credit, right? And that's what they teach everywhere. Save money, get good credit. Save money, get good credit. They keep people focused on that. But if people just focused on saving money and getting good credit, the banks make more money when you save money, and the banks definitely make more money when you're trying to get good credit because you're going into debt with them. So it basically teaches you the basics of the banking industry, how the banking industry works, how the mega banks sort of keep you focused on the wrong things to enrich the mega banks, and how you don't really need them. So it's a good book on basics of finance, and I think it's a really good starter. And that's really what wrote that book for. The next book was Top 10 Ways to Avoid Taxes, and that's really a book for somebody who's a little bit has a good foundation on finances. They wanted to step it up a little bit. They want to learn the basics of building wealth. They want to learn the basics of what's called other people's money, and they want to learn how the strategies on building wealth, even risk-free, tax-free, how to not pay taxes when you grow your money, how to retire with no taxes, how to pass money your taxes to your heirs tax-free. And it's just a little bit of a step up. And then I'm working on a third book right now. But those are the two books that I've got so far on Amazon. And again, they're great reviews on Amazon, and more are coming in every single day. So pretty excited about those.
Great. Tell us a little bit about where we can find you. Besides that info there, are you on Facebook, social media, website?
Yeah, easy to message me on Facebook. Facebook, there's Instagram, on Instagram. So usual social media channels. Yeah, I'm not hard to get hold of. If somebody wants to get hold of me, just like you did, you just jumped onto Facebook, search me out, sent me a message. I respond fast to people, especially if they just need some financial tips or whatever it is. So absolutely, pretty easy to get hold of.
Let's get into yes, sir. You are very kind and very gracious, very easy to get a hold of, and I concur with that. Well, let's get to your book. Let's start with Rich Man, Poor Bank. Let's start with Rich Man, Poor Bank. It's all written up in mine, it's all highlighted, so in depth. Give us the underlining premise of the book, and I'm going to have some questions for you to dig deeper. But give us the underlining premise of the book.
Okay, so the underlying premise is that if financial literacy goes up, bank profit goes down, and if financial literacy goes down, bank profit goes up. So if you raise your financial literacy, the banks are going to make less money, and that is true today as it always will be. If you look at the banking industry, there's a pretty good system in the banking industry, and it basically says it works very well for profitability for the mega banks, publicly traded financial companies, is that if you just keep a person, well, for instance, tell me this sounds familiar. You go to school, they say save money, get good credit, and they say, hey, you need to open up a checking and savings account. You're like, oh, that sounds good. Mom told me to do it. Dad told me to do it. Teachers tell me to do it. All right, sounds good. Checking, savings account. So then you go to college and they say, hey, get the introductory credit card, student credit card. We're going to help you build your credit. You're like, oh, that sounds good. They say, charge up the credit card. Okay. And what you don't realize is that they're trying to sell you 5 products, because statistically, if you buy 5 products from a bank or financial company, whatever it is, you're going to stick with that company and they're going to become the primary advisor for you. So you have 3, you have your checking, savings, credit card. And then they say, hey, you need another credit card because you need to build your credit. So you go to the Macy's and buy a new shirt and charge up the credit card. And then say, get a car loan, an auto loan. And if they basically sell more than 5 products to a customer, that's going to be your primary source of financial literacy. And if a mega bank is giving you all the advice on your finances, I guarantee it's for profitability of that mega bank, publicly traded, to make money for the stockholders. And that's really what it is. So, it's the difference between what most people are taught is, save money, get good credit. Rich people aren't focused on that. They're focused on investing, tax avoidance, things like that. So it's just, again, where you get the source of your information. If the primary source of your financial literacy is a publicly traded mega bank, you're going to have some problems when it comes to finances in the future, because they're not there to their primary fiduciary responsibility, meaning that their goal is to make money for the stockholders, not make money for you, and that's a huge conflict of interest. So people need to understand that you have to find better sources of financial literacy, and you're not going to get it in college. You're not going to get it in university. You're not going to get it in our public schools. You're probably not going to get it from your parents, because your parents were taught from those same education sources. You're probably not going to get it from, you just have to go out somewhere else and you have to get it. And I never got, my financial literacy didn't come from college. It didn't come from business school. It didn't come from my parents because they didn't know it. It came from me reading books and those things. So that I just realized I needed a different source for financial literacy.
Thank you. So powerful. Share this page. We're on Facebook. We're on YouTube, our YouTube channel. Take time, share this page. We're digging into the first book by Mark, Rich Man, Poor Bank. Let's be explicit here. I know I'll do it. You can't. So that means Chase, Wells Fargo, Bank of America. They're not there to help us grow our money. The 0.001 that they give us in our savings account is not efficient. That we need to look into other ways. You talk about credit unions. Why do you recommend credit unions and opposed to the big banks?
Because it's who they're there to serve, and they're also not financial predators. The guy who designed the credit card industry, and I won't say his name either because I'm not supposed to say names. He built the credit. He was a Harvard-educated MIT mathematician, and he figured out how to psychologically dig the entire population into credit card debt, and then keep them stuck in credit card debt for the rest of their lives. And it had to do with the psychology of getting people into debt. The mega banks jumped on that. They said, "We love this. Let's do this." And the current credit card industry was built based on those premises of how to maximize profitability to the shareholders. Credit unions don't have shareholders. They're part of your community. They're not for profit. The members own the credit union. The members benefit. So they're there for basically to strengthen the credit union, pay their employees really good money, keep their employees, not become predatory. See, if a credit union, if a credit union drives a customer into bankruptcy, they go bankrupt, the credit union actually loses the money and they lose the other members' money. Makes sense? So it's like you're all into the same boat together, right? So you don't want to push people into bankruptcy. They're just not financial. They're not predatory like the big banks are. The money stays in your community. If you pay 24% interest on a big bank credit card, the money leaves your community and goes to Wall Street, to mega banks, the executives, the shareholders. It just leaves your community. It's like a vacuum sucking the money out of your community 24 hours, 7 days a week, just sucking it out. Then it never comes back to you, right? So a credit union, the money stays in your community. It stays in your community, stays with the employees, stay with the workers. Credit unions aren't going to make you wealthy, but it's a good start to getting, on a credit card, a mortgage, an auto loan, those basic things that you do, like saving money, getting good credit. If you need to borrow money, they tend to be more conservative, by the way. They're not going to take you if you have bad credit, right? They're not going to do that because that's the members, right? They have a responsibility to their other members. So they're very conservative. But if you just want to get out of debt, we've taken customers who have 24% interest at a bunch of credit cards, and let's say they have an auto loan at a credit union, and we might be able to take a person to the credit union, refinance the auto loan, and pay off a bunch of credit card debt. So they were paying interest at 24%, and now they're paying interest at, let's say, 5% on an auto loan. Now do the math. Interest at 24% for 3 years, where if you have interest at, let's say, 6%, it's how fast money doubles, and it just works well. We use credit unions all the time to help our customers get out of debt. But you also have to understand your credit score and that sort of thing. So those are all the things that I've been teaching. We talk about it in the books, in both Rich Man, Poor Bank and Top 10 Ways to Avoid Taxes.
Thanks so much for sharing that. Thanks so much for sharing that. Let's get into some specific questions about rich man, poor bank. Tell us about the 72 rule and why you felt you need to highlight that in your book.
Oh yeah, Rule of 72 is really the best message of financial literacy goes up, bank profit goes down is just the Rule of 72. And the thing is, it's not an opinionated thing. It's a math thing. Math does not lie. There's no opinion. It doesn't care what race you are. It doesn't care your background. It's simple math, right? If you have a savings account that pays 0.1, so that's 1/10 of 1%, that doubles every 720 years. So your savings account is doubling every 720 years. If you have a credit card debt and it's at 24%, right, it doubles every 3 years. So if your debt's doubling every 3 years and your savings account is doubling, every 7,200 years, you mathematically can never win, right? Now, the crazy thing is in the United States, you see lots of people, they're trying to save money and get good credit. At the same banking institution or whatever, they'll have $10,000 in a savings account and it doubles every 7,000 years. And they'll have 10,000 on a credit card at 24%, and that's doubling every 3 years. And literally, the money's in a savings account at a bank, and they're borrowing it from another bank. The 10,000 doubles, right? It's just crazy. They're literally borrowing money from banks and enriching the banks by saving money and getting good credit. And again, your debt doubles every 3 years. Your savings account doubles every 7,000 years. You mathematically can never win doing that. Yet people are told to save money. They're told to get 3 or 4 credit cards and charge them up to increase their credit score. Totally not true, by the way. I mean, I could go on a rant on this one, exactly how all the systems that are in place that are going to dig people into credit card debt and keep them in debt forever. All right. And again, the system was designed by a Harvard-educated MIT mathematician who built it perfectly to keep you in debt forever. So,
well, let's talk about the opposite of banks and how banks can use our money and leverage that for loans to you, and the percentage of the money that they're allowed to loan compared to the percentage of money that we have in the bank and we put in their account. So we're basically making the bank richer, enabling them to give us these loans for our homes and things of other nature. I don't want you to give it all, but just know these books are free for those that sign up for our mailing list, a donation of any kind. And then even if you don't and you need the book, just let us know. We'll get it to you. That's it right here. This is the first book we're going in by Mark, Rich Man, Poor Bank. Give us that one fraction and then we'll get into the next book.
Okay, good. So yeah, first, before I go over to what is called fractional reserve banking, I'm going to go over there's 2 types of people in the banking industry. You can become a revolver or you can become a deadbeat. Now, if I ask somebody, hey, do you want to become a deadbeat? What are most people going to say? They're like, no, I don't want to become a deadbeat. That sounds bad, right? Now, in the banking industry, there's 2 types of people. There's a revolver. A revolver is a person that keeps revolving debt on their credit card, okay? So they always keep a balance on their credit card. They pay their minimums and they constantly, that debt just stays on their credit card forever. They pay never-ending amounts of interest to the banking corporations. That's where the banks make all their money, on what's called revolvers. That's what the banking industry calls that section of the population, called revolvers. There's another small percentage of the population that are called deadbeats, okay? The banks call them deadbeats because they charge up a credit card and they pay it down to 0 every single month and they never pay any interest to the banking industry, okay? That's why the banking industry calls them deadbeats, because like we don't make any money off these people, right? That's what I do. I use my credit card for my business. I charge it up, I pay it off, I charge it up, I pay it off. I get all that free stuff. So the banking industry, the mega banks pay me to get good credit, okay? The revolvers they give away their entire future by charging up their credit cards. They never pay them off, and they just pay never-ending interest to the banking industry. If you took that interest and invested it, that could be millions and millions and millions of dollars in your future, right? So that's one aspect. Now, the other aspect is what the banks do with your money, right? The banks do, when you put it into a savings account, the money doesn't sit there. The bank says save money, but the bank doesn't keep the money in the bank. Make sense? The bank says save the money in the bank, but the bank doesn't keep the money in the bank, right? The bank does can lend out more than what's in your bank account. So if you have $100 in savings in your bank account, the bank can lend up to 10 times that amount. So $1,000. Okay, they can lend it to your sister. If your sister is at the same bank, they could be lending your savings account to your sister up to 10 times and charging you interest in your own household, in your own community, to your neighbors and friends. That's it. So they say save money because they can lend it out multiple times to other people. To understand, debt isn't money lent to somebody. Debt is 0 1s in a computer. The bank can just log a debt for $1,000 in a computer on a credit card, start charging 24% interest on 1,000, and that's it. There's no money moving around. It's just 0 1s in a computer charging huge amounts of debt, and that's how the bank enriches themselves by getting you in credit card debt at high interest rate, taking your money, paying you nothing on it, and then they can lend what's called fractional. They only have to keep a fraction of the reserves in order to lend money for mortgages and auto loans and credit card debts. Again, that credit unions can't do that with the same ratio. So again, they're much better for the community as a whole. They're better for the country, is that they're not lending. But again, debt can be used to make money and debt can be used to make other people's money. So you really have to make that distinction, as you can use debt to make money and you can use debt to just to buy things that go down in value. And that's really the difference, is you need to distinguish when debt can be good and when debt can be bad.
That's, ladies and gentlemen, you're going to have to sign up for his classes and more information. He's going to be, if his schedule allows, regular around here. You can see the depths of information that he has. We want to make sure you get both of his books. But you may not want to wait on us. You might want to jump on Amazon and get your copies for your mother, for your friend, for your cousin. It's about renewing the mind, thinking how we use our resources. And now we're going to transition this conversation. We're going to go from Rich Man, Poor Bank, Rich Man, Poor Bank, to our next book. And this is a powerful book, ladies and gentlemen. Top 10 Ways to Avoid Your Taxes. There's a powerful story that Mark has behind writing this book. I want him, if he don't mind, share that testimony that he shares in a book of what was going on in his life when it came about. And we'll get into that from there.
Awesome. Yeah. So I was one of those young guys. I thought I was invincible and super healthy, used to run up mountains and on the weekends. And then over a period of 2 years, I started getting sick. And I would walk up a flight of stairs and I would kind of feel winded. And I didn't know what was going on. And just by kind of, I guess, luck, I guess you could say, I went into a doctor and somebody listened to my heart. And they said there's something wrong there. And, so over the next, it was April 2018, I was admitted to a hospital for minimally invasive heart and valve repair, which is crazy, right? And I was like, well, all right, well, geez, I better, never thought this was going to happen. But, I was in the hospital and I said, you know what, I better make use of this time. I can't do any work in the hospital, but I'm going to make use of this time. And I just sat down and I was evaluating what I was teaching my clients, right? I've been in the financial industry for 15 years, and I was evaluating what I was teaching my clients. And honestly, it was a blessing in disguise that I had this surgery, because I really had a lot of time. I had 5 weeks to sit there and think. And I decided to start writing down my thoughts and that sort of thing. And it took me about 5 weeks to write the first draft of top 10 ways to avoid taxes. But I realized a lot of things, and I'll just read something. I guess if I could summarize the book a little bit. In one of the first chapters of the book, it says, and these are things where I was always sitting in a hospital bed in the intensive care unit of USC CAC Hospital, and I started writing down these thoughts. And I said, first of all, we'll go through is on the chapter of business ownership. It says, when you earn it, they tax it. When you save it, they tax it. When you spend it, they tax it. And when you die, guess what happens? Yeah, they tax that too, right? So I was like, okay, good. We need to teach people how taxes work. And especially we're in California. Taxes are going up everywhere, and especially in California. So you better learn how taxes work. And then I think the best summary of the book is the poor and middle class teach their kids how to get a job, how to save money, how to get good credit, and pay your taxes. right? That's what our colleges, our universities.
That's where I was going. That's highlighted in my book. That's underlined. That's notes next to it. Yeah, go ahead.
But that's generally accepted. That's like almost like a rule.
Good. Yeah. Oh yeah.
That's not even questioned in society. It's not even questioned. That's like, yeah, that's not even questioned. What the rich teach their kids: how to run a business, how to invest, and how to avoid taxes. And it's a completely different system. See, the difference is where you're getting your advice from. Are you getting your advice from, it's really where you're getting your advice from. And I think that was it. And these were all thoughts.
You can say it. You can go ahead and say it. I saw you stuttering. You don't want to say it. Are you getting your advice from poor people or lower middle class, or are you getting your advice from rich people? Go ahead.
Yeah. I had parents who were, my dad was a bricklayer. We lived in a bad community. I didn't have access to financial literacy. I couldn't ask my parents, hey, mom and dad, how does money work? Couldn't get access, certainly to the schools that I was in, where I wasn't in great schools, couldn't get access there. Where could I get access to financial literacy? It was non-existent. Now, fortunately, today we have the internet. We have, we can jump on YouTube or Facebook and get access to good financial literacy. In many ways, the people now have so much access to better financial literacy than they did a long time ago, right? So I think there's opportunities more, but you have to open your eyes and realize that you kind of live in a debt matrix. It's like the movie The Matrix, right? You live in a bubble and you don't know it. We all live in a bubble. It's where we getting our information from. The thoughts the things that you're told you can and can't do, the things you're told to do with your money, they're all in a bubble, right? You need to look outside the bubble and you need to start questioning. Right? They say if you're getting bad results, start asking different questions, right? Ask different questions if you get results, right? It's like, yeah. So it is a big topic. It's a really big topic of where you get your advice from. I was told that the 5 people you hang around with most.
Yeah.
Look at the 5 people you were hanging around with most. Where are their incomes? How are their finances doing? And you could say, well, yeah, money is not that important, but same thing with their marriage, right? The 5 people if they have a good marriage, great. If they have a bad marriage, you're probably gonna have a bad marriage. If they're unhealthy, if they're eating unhealthy, the 5 people, you're gonna become those people. It's there's no way to fight it. Your health, your faith, your marriage, your finances, all those things come down to the 5 people you hang around with most, right? So you decide your future, and in the people you hang around with, the books you read, the what you watch on television, all that stuff is determined. That's the good news, is you have power to change it. That's the great news, right? But it's bad news for the people that don't want to change it, and the people that don't want to learn finances and just start questioning, right? For me, it was always questioning. What am I learning? What am I learning? Is this the right thing? Where's this going to get me? And I'm constantly questioning, even to this day.
Yeah. Big Mama would say, bad company, birds of a feather flock together.
Yeah.
And so Bible tells us bad company corrupt good morals. You are who you hang with. And that's one of the pointers, business ownership and home-based business, whatever it is, business ownership, how to leverage that into tax avoidance. Let's get into another one. And there's 10 with a bonus one in the book, and that book is available to you. This is just meant to whet your appetite, because this interview is not going to be able to indulge in everything. Mark does not have that time, but if you're in the right bracket, you want to reach out to him for information and assistance. But let's talk about the rich man's Roth. Most people here are familiar with the Roth IRA. I was surprised you do a whole chapter on it and then end the chapter by saying, I don't have one. And but find out reasons why, I'll tell you later on, I believe in chapter 7. Tell us what the rich man's Roth is and why those that are listening ought to think about diving into the area.
Yeah, first of all, the topic of what's called an individual retirement account versus a Roth, right? When an individual retirement and a Roth were created, tax brackets were much higher. The argument to defer money in a retirement account isn't really as valid as it was a long time ago. And I think it's actually bad advice for most people to stick money and invest it in a basic mutual fund in a retirement account for the next 30 years. It's just not a good investment for a lot of reasons. Even a Roth IRA, there's no match. There's no matching contribution on a Roth IRA. So yeah, for me, it's a simple rule, and it's a very simple rule in my investing. It helped me clarify in my own mind. This came part when I was writing Top 10 Ways to Avoid Taxes. I said, what's my rule on my investing? When I'm investing, what's the number one thing that I look for? Simple. Can I use other people's money in my investing? Can I use other people's money in my investing? Right? OPM. If the answer is no, for me, it's not a good investment. So I'll start off with that. I don't have a Roth IRA because I can't use other people's money in the investing. Okay, that's for one. Two, I make too much money to fund a Roth IRA. Okay, I used to have no money. I used to be poor. Now I make too much money. Congratulations. I'm excited about that, right? But yeah, a Roth IRA is you can only put $5,500 a year in it. If you make too much money, you can't put the money into it anymore. And for most people, it's invested in a diversified portfolio of mutual funds. Okay, those investments just don't compound fast enough in your future to make money. So a rich man's Roth is a tax code 7702A. It has to do with life insurance. And whatever you put, life insurance is like a bucket, right? You can put stuff into it. You could put stocks and bonds in there. You could put a bank account type of thing, a fixed rate of return investment. You can do a lot of different things inside there. But I personally use insurance as a wrapper, and you can invest money today where you can grow the money with no taxes. You can take the money out with no taxes. You can withdraw it with no taxes. You can borrow from against it with no taxes. You can, retire with no taxes, and you can die with no taxes. Okay. So that's a rich man's Roth, is that there's no limit to the contribution. Some of my clients are putting $500 a month into this plan. My largest client is putting $300,000 a year into this plan, $300,000 a year, because there's no contribution. The rich people can't use a Roth IRA because they can only put $5,500. There's no limit to the contribution. So it's sort of becoming the vehicle for wealthy people to stuff very large amounts of money into a tax shelter where it's after-tax money, similar to a Roth IRA, but they can grow with no risk, no taxes. They can borrow from it to fund businesses, to pay off real estate, fund their kids' college funds, whatever the purpose is, grow their business. They can use it exactly when they want at any age. So that's why it's somewhat called the rich man's Roth in there. But the great thing is anybody of any income can use it. The client that I talked to on Friday, we're setting up for $400 a month for him and his wife to start this plan right now. So it can be used at any income. But again, for me, it uses other people's money. I can invest the money, I can grow it with no risk, and I can borrow from it to invest in other areas. And I can do that with no risk to my principal. So for me, it uses other people's money, and the gains are not taxed, which, we're in California, so we're in the highest tax place in the world, right? Or at least in the United States right now. So yeah.
Well, probably second to New York, but point taken. Tell us about other people's money. We've heard that term thrown out just now. Tell us about other people's money. Then I'm gonna go back to the information there.
Okay, other people's money is a pretty simple concept, and I can tell you that the 99% don't use it enough. They use it sometimes, but they don't know the results of it. The 1% focus on it 100% of the time. Okay, it's their number one thing. They focus on other people's money and other people's time. That's why they are the top 1%. But I'll tell you how successful when the 99% are using it. Okay, simple. You go to your job. You're working at a Starbucks or whatever the company is. Doesn't matter what company. And you put $1 in your 401k plan, and the employer puts in another $1. That's other people's money. Okay, somebody else is putting money into your investments. Take that. That's free money. Okay, that's a great opportunity there to get other people's money. Okay, so that's the first area where they're using other people's money. The other accounts, retirement accounts, Roth IRAs, there's no other OPM in those things. Yet people are told to fund those things. I don't agree, right? So again, simple Roth or a 401k, you get a match. That's other people's money. But people overfund it. They put way too much money and they're not getting the match. I don't think it's the best use of your money. The other area is basically when I bought my first condo in Van Nuys, California, Sherman Way and Kester, for anybody who knows wasn't a great neighborhood 20 years ago, still not a great neighborhood, but better than it was. bought my first condo. I put $5,000 down on a condominium. The condo was $140,000 then. Okay, bought that condominium, lived in it for 2 years. The property value started skyrocketing. Right, eventually I sold that condo and I made $120,000 profit. So I put $5,000 down and I made $120,000 in profit, because you can live in a home for 2 years, and if you live in it, there's no taxes on the gains. That $120,000 was free of all state, federal, and capital gains taxes. So I put $5,000 down and I made 120%. I made 2,400% rate of return on my money in 2 years. That's an example of other people's money. Real estate, right? That's another example. Is if you put a down payment on a house, the bank puts the other 90% up to buy the house. Okay? Even if the real estate makes 6% rate of return, you only put 10% of the money, the bank put the other 90. These are very high rates of returns on your money for investing. That's why a lot of the wealthy people focus on buying real estate, right? Just other people. So those would be the most two basic examples. Another is where I can invest money into an insurance policy, grow it with no taxes. I can borrow from it to buy real estate. Now, let me give you an example. If somebody borrowed $100,000 from a life insurance policy, they borrowed other people's money, and then they put $400,000 from the bank in. If they put the $100,000 from the insurance company and the $400,000 from the bank, they put none of their own money in their investment, right? They can't even calculate the rate of return. So that's other people's money plus other people's money. Okay, so that's just an example. But again, the middle class usually do it properly with a match on their 401k. They buy a home. Those assets are their greatest investments, but they just don't do it again. They don't seek other opportunities to use other people's money in their investing. They do something successfully, but they don't continue to do it, right? If you buy one home, what's your next goal? Buy another one, right? Rent it. That should be your goal if you want to build wealth, right?
Yeah, and the ideal of other people's money is that you have good investment opportunities that must come alongside with that. It can't be go to the mall, go get your charter a boat. It's about other correct investment opportunities that make that work.
I'll give you a specific example. Okay, yeah. I have a client who they didn't know what an accessory dwelling unit is, an ADU. Right, in California, you can turn your garage into a guest house. Okay, I've got a couple clients. I sat down with them and said, hey, you have equity in your house and you have room and you have a garage in your backyard. You have all this equity in your house. Why don't you pull out some equity and go convert your garage into a guest house? They're like, really? They said, well, no, I don't want to borrow against my house. I'm like, are you kidding me? You can turn your garage into a rental property really cheap, and then you can pay off your house with it, right? It's a difference between that's other people. You're borrowing a small amount of money and you're building a guest house, and that value, that rent can come in from that guest house. But there's people in California that can do that like tomorrow, and they don't even see it. They don't see the opportunities. It's like they stuff all their money in their retirement accounts. It's locked there till they're 60. Yet they could have just paid the taxes on it, turned their garage into a guest house or extended their house with an ADU, increased the value of the real estate, increased their income. And and there's so many people that are just sitting on that opportunity in California right now, and they just can't, because again, they're in the bubble. They're like, save money, get good credit. They're like, stuff all the money in your retirement accounts. You're basically you're making the banks rich and you're making Wall Street rich. That's all you're doing. If you want to keep doing that, great. The banks love you. Wall Street loves you. You're enriching the banking corporations. You're enriching the investment houses by putting all your money in retirement accounts for the next 40 years. You're making them wealthy. You're giving them their money. They're using your money, and they're getting rich off your money. That's really what it is. Like, no sugarcoat it. You want it straight. There it is. That's what you're told to do. Is it Wall Street telling you what to do with your money, or are you becoming financially educated and saying what's better to do with my money? Right? How do I use the bank's money to make myself wealthy instead of the bank taking advantage of me?
Absolutely. Absolutely. And if you're interested in ADU, I know a company out here, I've forwarded to a few people that can do it. They can do that. Some people looked into it. Members I gave the information to, and they're excited about the potential of it. Just got the picture of the day. As a matter of fact, I forgot I sent it to them. I don't qualify for ADU just yet, but we're working our way towards that. Tell us the name of the insurance
IUL, I know what it means, but just tell us what that is. And if people are looking into it and they want to use you, they're in the California area, wherever you're licensed, tell them how they can connect with you to get going with that.
Okay, good. Yeah, I'm licensed all across the country. Most of my clients are all across the country, and I'm now getting international clients who are like bringing money in from other countries. So I'm licensed everywhere in there. So Index Universal Life. Okay, first of all, it's a tax code. Simple. Let's define this. We got enough time. It's a tax code called 7702A and 7702. It says whatever you put in the investment account, right? A universal life policy, which came out in the 1980s, was like putting a bank account inside an insurance policy. Okay, 1980s interest rates were like 16%. So if you took a 16% investment, put it inside an insurance policy, you had a 16% rate of return or 14 or whatever, and it grew without risk. Okay, Index Universal Life was created when rich people used to put money into bonds where there's no risk of default unless all the corporations default, which they're not, and they would buy what's called a stock option. Okay. So it's a very sophisticated investment that people can participate that don't have to be sophisticated, right? You invest with a company in insurance policy. The insurance company puts the money into bonds, and then they take the interest and they buy what's called call options. These are pieces of paper that bet up on the market, okay? So these, no risk. The money is not in the market. The money is in bonds. They take the interest and they bet up. So if you're right, you have your principal plus your profit if the market goes up, okay? Because it's in the wrapper of an insurance policy, there's no taxes on the dividends, there's no taxes on the gains. So without trying to get too technical, you can Google market-linked CD. A market-linked CD is an investment that can't lose money. If you put a market-linked CD and put it inside an insurance policy, you have a tax-free and risk-free investment. Okay, it's not a new concept. It came out in 1997. It's not like something new that they're testing it. Is it going to work? 97, it was created. The tax code's been sound since 88, has not been amended. There's big companies that do this. Just because you get an IUL doesn't mean it's the same. These are apples and oranges. There's a lot of different ways to design these things and build these things. There's a lot of them that I wouldn't buy. Just because it says IUL doesn't mean I would buy it. I'm very particular on the features. You can invest money with no risk and no cap in the stock market under certain circumstances, okay, and no taxes. So without getting too much into a deep dive, they're called Index Universal Life. I kept getting so many questions on this. I wrote a third book. Okay, it's going to be released in a couple weeks. It's specifically a book on top 10 ways an IUL can secure your financial future and build a tax-free family bank. Okay, we're editing, formatting. You're going to get it on Amazon, but it's literally 25 ways. There's so many different. It's about designing a purpose. I have one client. He's so excited. He said, "Mark, I want to pay off my home." He was sending extra principal payments into his home. I said, "That's a bad idea because your interest rates are so low. You're at 3%. Why would you lock up your money at 3% for the next 20 years trying to pay off your home? Bad investment. Take it, put it into an IUL. We can grow that money into an IUL, and we can write a check in the future and pay off his home much faster than we can by paying extra." That's just one example of a client who wants to pay. That's his goal. Some people want to buy more real estate. Some people want to send their kids to college. Some people want to fund a retirement plan. Some people want to just build the money in case there's another stock market crash. They can go invest in the markets after the crash happens. It's just what's your purpose. It's designing it specifically for your purpose. Some people just need life insurance and long-term care. They want to protect their assets because they see their grandparents or parents are getting sick and they see how expensive it is for care, right? Long-term care, life insurance, all that stuff is for asset protection. So it really performs 5 different things. If you die too early, your family gets money. If you get sick, there's long-term care, which is going to protect your real estate, protect your assets. You can grow your money with no risk. You can grow your money with no taxes. And in some policies, you can borrow from the insurance company without liquidating the investments. You can use other people's money for your investing in some cases with certain insurance companies. So that's really it is. It's like a Swiss Army knife of investing. Very useful tool. So,
Mark, I think we need to set up a Zoom and say whoever's interested, you just come in and give a full-fledged talk, because I'm sure a lot of people are listening, wanting more information about that and how to connect with you. It's a win-win-win to get you business. It gets people informed. I have no problem, no hesitation to saying that. Gets people informed, and if it fit, then you wear the shoe. If it doesn't fit, you just keep on walking across the street and wherever you're going. This is powerful information. We have both of these books from this author available to you. Sign up for the Hurting email list, and also make a donation of any kind. We'll get that book to you. If you put 1 penny in there to Hurt for the Hurting, you'll get the book. It's already been purchased from our author today. We want to thank him for doing that. We have yet still some that hopefully are on their way. Hopefully nobody didn't steal it from the mailroom. We got most of the top 10 ways to avoid your taxes. Connect with me. If you're interested in a Zoom call with Mark, let us know. I already have someone said set up a Zoom. Lee Edwards. So we can start having that conversation, give Mark that business, and this kind guy will also make sure that we all are taken care of in that area. Mark, tell us about the release of the book. Do you have a proposed date? Is there a pre-order? We can do that for Hurt for the Hurt. We want to get how we do. We want to support it right off the bat.
Well, I'll tell you what. This as soon as I'm gonna text my guy who's formatting it right now. But here's what. As soon as it's out, the first 25 bucks I'm going to go to you. I'm just going to send you 25 for free. You can give them out to whoever you want as soon as it's out. So I don't want to give myself a deadline because this has been like 2 months of format, whatever. But I'm going to work on getting it out. Minimum within 2 weeks. And I'll send you 25. Of the first ones off the draft, off the copy, and you can give them out to you.
Send us 25, we're going to buy 50. You send us 25, we're going to buy 50. So here you go. We're going to double you. So you give us 25, we're going to send you 50. Then we're going to Zoom. Everybody's blowing up saying, hey, they want a Zoom call with Mark. I don't want them to flood you. They may be hearing something and not clear. So we'll set up a kind, Mark, if that's cool with you. Jump on Zoom, invite only. Only those that are serious get more information, and then they can follow up from there. A lot of people call it infinite banking and things of that nature. I'm already working with somebody myself, but I can pass that information on to others, certainly that can be a benefit to them. Before we let you go, Mark, let us know. Let's talk briefly about what I think a lot of people who may have rental property out there don't know. At least I didn't have rental property. The depreciation of rental property, the number 9 strategy for avoiding your taxes. Let's talk about that. And then in closing, remind them where they can find you, and also the upcoming Zoom call about the IUL.
Okay, good. Yeah. As far as where to reach me, if you just put my name in, markjquann@gmail.com. That's a pretty easy one, right? markjquann@gmail.com. I try not to put that out everywhere because I do get a lot of email, but that's the best place to do it. As far as chapter 9, right? Oh yeah, depreciation. Sorry, just did a podcast on this. But yeah, so there's what's called depreciation on rental property, right? Which is basic. You buy a piece of rental property and you depreciate that rental property. So for example, if you were renting a property and you received $10,000 of income, but the property is depreciated, from an accounting perspective, if that depreciation was 10,000, meaning they log it as the property is going down in value. If you received 10,000 and the income was 10,000, there's no taxes on the rental property. That's why real estate is so powerful. You can buy real estate and you can live in it and sell it in 2 years and pay no taxes. You can rent real estate and the income can come in. A lot of it can be not taxed. Okay.
Yes, if you're single, 250,000. If you're married, 500,000. So if it goes over that, it will be taxed.
Exactly. So you can buy real estate, live in it, and sell it with no taxes. But if you rent the property to somebody else and you're collecting rental income, that can also be income that's not taxed to you. There's lots of different ways to have real estate and eliminate the taxes. Now the cool part is there's two acts, and this is understanding taxes. If you have rental property and let's say you collected $20,000 of income, but your depreciation was only $10,000, you had twice as much income. You can do what's called accelerated depreciation. You can bring the depreciation forward. That's because of the Jobs Act, 2017. There was the Jobs Act. It said if you have commercial or residential properties and you rented the property or rental, you can actually bring the depreciation forward. It's called accelerated depreciation. It's called cost segregation. It's looking at bringing the cost of the real estate versus the personal property, depreciating the personal property faster. Again, it's called cost segregation. You can bring it forward. So the Jobs Act made it so you can go forward and bring the depreciation forward. Okay. The CARES Act, which is the Coronavirus Act recently, so you go back in time 5 years and do that. So there's a lot of people that have commercial real estate, they have rental properties, they're collecting income and they're paying taxes on some of that income. With a cost segregation study, you can actually either bring the depreciation forward or actually go back 5 years with a study and bring it, go backward in time. So there's lots of opportunities to reduce income taxes on your rental properties through the Jobs Act and the CARES Act. And what's crazy is most people have never heard of that. I've talked to people who own lots of commercial real estate and they say, how come nobody told me about that? I'm like, it's because you probably have a CPA that's not working very hard to do that. I hate to say it, but a lot of CPAs just do taxes all day, do taxes, but they're not sitting there going, hey, how can I help this client? How can I help this client? How can I help this client? What are they doing wrong, right? If you have advisors, as you make more money, you have to replace your advisors, right? You have no money, you have your bank as your advisor, right? You start making money, you still keep your bank as your advisor. Bad decision, man. That's it's not going to work. You need to upgrade your advisor. Now you're making more money. You get a good accountant. You incorporate your business. You get to an S corporation. Well, if you make more money, you better look at why not evaluate your advisors? Why not check out my CPA? Right? Have another CPA look at my tax return and see what it looks like. Where's the downside? A CPA will do it for free. I got CPAs that'll look at your tax return for free. They'll either say your CPA is doing a great job, or they'll say your CPA is doing a horrible job. You're way overpaying. Okay, we've saved a client $50,000 in taxes recently because we had a CPA look at their tax return and say, "Are you kidding me? All the mistakes your CPA is making. They're not doing cost segregation. They're not incorporating. They're not doing things right." So, anyways, it's just you got to check where you're getting your advice from. We started this call with where do you get your advice from? I think it's check it again. Where are you getting your advice from, right?
Absolutely.
It's so important to just question it. Where am I getting my advice from? Is this the right plan? Is this the right person? Is this person becoming financially independent? Does this person have a plan? Ask your financial advisor, what's their plan for becoming financially independent, right? If they say they're going to put their money into a retirement account for the next 30 years, and dollar cost average, run. Get some different advice. That's not what the wealthy people are doing.
Absolutely. Listen, Mark, we respect your time. We respect your work. We're going to get you out of here, but we're going to set up that Zoom call to give you the opportunity to talk to people in more detail and then set up that series after that one-on-one. So we'll do that quick. Be on the lookout for that information. Be on the lookout Wednesday, Wonderful Wednesday. Leah Pump, the founder and president of the Ladylike Foundation, to be with us. Theological Thursday, Pastor Dr. Ray Pritchard will be with us to talk to us about everything that's going on. There's some things that I want to get his insight and even challenge his perspective on. And so you want to be there for that conversation. Next week, we have a powerful lineup. Reverend Dominique Robinson will be here on Wednesday for Wonderful Women. We're hoping to land somebody for Monday that you don't want to miss for Money Matters Monday. If we cannot land that person, we may do our Zoom call during that time with Mark, a little more private, intimate setting that's not all on social media. But we'll make that happen within a week. We'll make that happen right away. And then next Thursday, we have an official partnership with Logos, Faith Life, with this Hurt for the Hurting platform. We're going to introduce that to you on next Thursday. You want to check out that interview. We're excited about what God has given us favor in that way. Everything we do for the Hurting Hurt Foundation comes mainly from these here pockets. And so this door that's being opened is a great vessel those of you that have donated in the past and present, thankful for that. Has been a great help for us as well, as we're on the radio, we're on television, we're on this platform. We're always trying to support our guests for giving their time to us, be it buying their books and resources. We just feel like that's fair game. And then if we ever have to pull the Godfather mode out, where it says, I may need a favor. No, we don't need something from now, but I may need a favor. If that day should come, we'll tap it out. Those that are Godfather fans understand that. Those of you don't, go watch the movie. Shame on you. I'm going to pray, and I want to thank Mark again for his time. I'm going to pray, and then we're going to let you go. Please like this. Please share this. Let's blow this page up, because of the information and the content is worth doing. So, Father, we're grateful and thankful for Mark. We're thankful for the gifts, talents, and information you instilled in him. I pray for everybody that's listening that we will be Proverbs 3, 9, and 10 people, that we will honor you with our wealth and with the first fruits of all our increase. For our barns will be filled with plenty, our vats will be bursting with wine. We pray that you'll breathe on all our plans, no matter how skilled, how intuitive they are. Lord, we need you to breathe on them, let them come to pass. I pray for salvation for those that are lost, edification for those that are saved. Every need be met during this season of pandemic, political chaos, civil unrest, mental strain, and economic uncertainty. All these things we pray for Jesus' sake. Amen.
Amen.
All right. Thank y'all.